You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from the Moose on the Loose. Happy Wednesday. Tomorrow we are going to have Brookfield Corporation that will report their earnings. But last week, three of the children companies, I would call them, so Brookfield Renewable, Infrastructure, and Asset Management, reported their earnings as well. So I just thought of doing a quick wrap up to warm you up for tomorrow. If you hold any of the Brookfields, and of course, if you have renewable, infrastructure, and asset management doing well, chances are tomorrow morning it's going to be the celebration of Brookfield Corporation great results. So let's take a look at what happened. I'm going to take a look at Brookfield Renewable as a starter. The year-to-date revenue, year-to-date total return for this one is 19% for the corporate class share, so capital plus stock price. About like following the same trend of the market, not a big outperformer. It's been a tough ride for the past few years for Brookfield Renewable, so it's great to see that it's in positive territories this year. However, when you look at the financial metrics, it's always the same. The metrics look good. Brookfield Renewable reported funds from operation per share, so FFO per share, up 11% versus last year, mostly driven by acquisition and also inflationary rate. So with all the utilities they have, the hydroelectric plant, wind farms, and solar panels, they do have the ability to increase their rate following inflation, and of course a little bit more than that. So that helps the company to generate more and more funds from operation. The company saw that the demand for energy keeps on growing. There is also another theme here about artificial intelligence. Those technology companies are requiring a lot of computing power, and computing power, well, needs a lot of energy to work on. So the demand for energy keeps on growing. The company is also looking for energy storage and distribution potential acquisitions in the future. So everything looks pretty good for Brookfield Renewable, even if the stock price got a small drop after Trump's winning the election. All renewable stocks on that day weren't that doing well, but now it's kind of like small market movement. You know, like some investors are trying to make plays thinking that something is going to happen, but sometimes it doesn't happen at all. So we'll have to see moving forward. But in the meantime, Brookfield Renewable is doing good. Brookfield Infrastructure year-to-date return at plus 32%. So definitely better than Brookfield Renewable. The FFO per share was up 4%. So like okay quarter in that part, again driven by acquisition and also inflationary rate across multiple businesses. What's interesting with Brookfield Infrastructure in this quarter is they once again show you how their expertise in asset recycling works. So what's this asset recycling is you buy an asset, you make it profitable, you improve it, then you sell it at a higher price. And what you do with the proceeds? Well, you buy other undervalued assets and you keep that flywheel spinning. This is exactly what they did not too long ago. They sold their an Australian regulated business. So for the utility segment, the FFO per share were lower than last year, but on the other side, in the transportation business, it was up by 50% on acquisition. So again, selling assets at a very good price, buying undervalued assets, of course, as per their calculation. So it doesn't necessarily mean that they're going to be right every single time, but whenever they think they can make a good deal, they sell high, they buy low. That's pretty much the like good solution to make money, right? Another segment that has been doing very well as of late is their data center. So it's the smallest portion of their business. It's about 10% of BIP. But those funds from operation were up by 29%. Again, due to increasing of the rates and also acquisition. So you can see the same pattern here where the company is doing the same playbook over and over again, but it works. So this one also had a rough time. Now it's up 32%, outperforming the market this year. So it's more like in a recovery mode though. So don't get too excited by those two, BIP and BEP. Still, it's better than losing money once again, right? For both companies, one thing I dislike, and that story keeps on popping up. They're super complex to analyze. Their financial structure is crazy. And once again, they announced that they will be doing another restructuring of their capital structure. The reason is to comply for tax laws in Canada, which they don't mention much in the press release, which is kind of disappointing. So it's hard to get like the real information about what's going to be the impact. So far it hasn't moved the stock price really, so I don't think it's gonna have like a material impact, but I wish I could have like a clear information from that part. It's always a bit tough to analyze when it comes down to look at the capital structure. BIP, good results. BEP, good results. What about BAM? So BAM, not to confuse with the previous BAM. So Brookfield Asset Management is actually a spin-off. So now the big parent company is Brookfield Corporation. So for BAM, the business model is just based on fees they charge on the capital. So their business model is all about raising more capital, investing that capital, and charging a fee on it. So they are asset light alternative asset manager, meaning that they just manage everybody else capital, but they don't use their own. They have rose 21 billion in Q3 for more capital, and so far this year they rose 135 billion. So that's a lot of billions, and that's a lot of fees. So you guessed it, earnings were up 9%. The stock price is up 52% year-to-date total return, including the dividend. So more than 50% return for BAM shareholders. Congrats to you, my friends. I do not have BAM. I have BN, which is pretty similar right now. It's up about 50%, including the dividend. So both companies are doing great. The main difference between both is Brookfield Corporation is investing its own capital on top of raising capital. So, and it owns like 75% of BAM. So that gives you an idea. There is definitely a big appetite from investors to invest in the energy transition, to invest in AI infrastructure, and to invest into private credit. So investors are looking for alternative ways to not just invest in public companies, but on those long-term assets in the energy world, into the AI infrastructure, and it's like Brookfield is one of the biggest and most experienced asset manager, alternative asset manager, which makes them quite attractive, and that's why they are able to raise that much capital. So what am I expecting from Brookfield Corporation tomorrow? Well, similar, probably like mid-single to high single-digit earnings per share growth. Good performance overall, as we saw that most of their children company did well. Well, technically, they should do well at the same time. So this one is definitely a key position in my portfolio at this point. Super happy to have added Brookfield Corporation about, I think it's like 18 months ago or something like that. So still super complex to analyze, requires a lot of time and a lot of faith into management as well. But I think it's worth it for a portion of my portfolio anyways. So again, not trying to take like super high risk here, trying to keep the position to an interesting weight, but not overweight either, because I know that if there's any problem with one Brookfield, it will likely contaminate the others. So, all right, Moose, that's enough for today. Again, don't forget that I have a brand new webinar on November 28th. You can register at moosemarkets.com/webinar or in the show note. And we're going to talk again tomorrow. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.